11 odd percent. Mayuresh Joshi from Angel Broking is now with us. Mayuresh, good afternoon. What's going on in these metal pack large cap ones, Tata Steel, Vedanta, JSPL? Anything that you would look to buy after the recent correction?
Afternoon, Pankaj. Clearly, I think one has to look at this space with a stock-specific approach. Tata Steel operationally and optically, good set of numbers because the margins that were expected to come through, they did beat that estimates, at least on the domestic side. Similarly, I think for the metal space overall, I think there is so much of concerns emanating from China, and those concerns are going to stay and linger on metal companies' balance sheet, both ferrous and non-ferrous. You look at realizations going down, and though raw material costs have also come down significantly, I think it's more of an offsetting effect in terms of realizations coming down as well for the end products. Add to that, I think the kind of capex that these companies had done in whatever fashion over the past few quarters or years, I think that utilization is not going to come through because the fall in demand is going to be quite stark. And again, I think expectations of softer commodities over the next few quarters are not going to impact how the margins are going to expand. So I think margins are going to remain soft, cash flows remain muted, and clearly that's going to have a big toll, especially on the leverage balance sheets. So Vedanta, JSPL, with the kind of leverage positions that they've got, even Tata Steel for that matter, I think they are going to take a hit when it comes to their end realizations.
But don't you think a lot of it is already factored in? I mean, I look at Vedanta Limited, it's down 20% in the last 3 days. Tata Steel, of course, because of the results, there was that blip. But otherwise, it's a big underperformer. Similar is the story with JSPL. Don't you think that there is too much already factored into these names?
So clearly, I think a lot would have got factored in even at higher prices, Pankaj. But in the event and a scenario of falling commodity prices and no certainty on when the cycle would turn, there is always this apprehension on how these stocks would reflect their earnings and how the cash flows will come through, specifically for these commodity-driven companies. So I think it's a cautious stance that the markets are taking. And yes, I think even though the attraction in terms of valuation is quite evident, I think it will be a brave man to probably come down on the street and say, I think we can buy this aggressively at this point of time. So it's going to be still a wait and watch mode on how the commodity cycle pans out over the next few months or quarters. And again, I think take a call at that point of time. Yes, I think I support your argument that valuations are attractive, but again, I think we will look at better counters rather than metals at this point of time.
Do you think after the yuan depreciation, most of these companies would have to cut down their prices? Is that the key reason why the steel names are going down after what has happened, despite some marginal import duty being increased? The competitive pressure in the export market is something which is now being factored in.
So clearly, I'll just cite an example. You look at the iron ore pricing that has come through over the past few quarters, and look at where NMDC quotes at iron ore prices. So I think you have to cut down those prices. You have to be competitive. And in fact, in both parts of iron ore, in terms of fines as well as lumps, so I think the price is still higher than what the imported cost of iron ore is. Similarly, I think if you look at the other metals as well, I think the realizations have come down big time. So yes, I think in terms of the end product, I think the price cuts would be quite evident, quite stark. And that, as I said, would couple with the kind of softness that we've seen already in pricing power that these companies reflect. So clearly, I think that is going to take a toll on their balance sheets. And I do expect that where the prices are still marginally higher, I think where demand is not coming through, you will still see some price cuts come through.
Mayuresh, just stay on with us. Piyush Jain now joins in from Morningstar. He tracks the metal space very closely. Piyush, we had a chat earlier about metal stocks going down. Vedanta is now down another 10%. Tata Steel is down another 5 odd percent. You think now too much pessimism is being factored into these names?
Yeah, in a way the question becomes quite tricky. So first of all, I think good afternoon to all the viewers, and thanks for having me on the show. I think it's a case of a falling knife. If you look at the environment around, and if you look at the news flow, we have been hearing that the steelmakers in US, they are requesting for anti-dumping duties on the Asian steelmakers, some European steelmakers. Steelmakers in UK, they are requesting for anti-dumping duties on the Chinese steelmakers. In Indian steelmakers are requesting for the same. So when you look at all the news flow, what it is telling you is that the demand is really not there. And there is excess capacity across the globe, and the high-cost steel makers and the commodity makers, they are really struggling to at present to operate at a decent optimum capacity utilization, which means their margins are falling. And usually when the margins are falling, the earnings, they're not expected to improve immediately. So basically the pain lasts for a longer time. So which means that you might see the stocks, some stocks would have fallen, some stocks would have already made the due, but some stocks, the fall would be remaining. What I think would be good for the investors to see is that it's much better to avoid these sectors and stocks at present till you really don't expect a major improvement or some improvement in the demand environment. Because there are other sectors, there are other stocks which continue to actually present good growth opportunities, and it is much better to be in those stocks.
Right. Tata Motors is one name that you track. 349 is where it is right now. Okay, 349 is where the name is. What would you make of that and China's relation? I mean, you put the Chinese relation with the metal names. What with Tata Motors? How does it impact Tata Motors?
I think it will impact Tata Motors indirectly, not directly. What the only impact we would be watching very closely is that how real is the slowdown. So like some slowdowns are sometimes temporary, maybe due to economic events, due to corrections in the stock markets. But how prolonged is the slight downturn there? In terms of the luxury vehicles, usually the luxury vehicles, they don't follow the economic downturns. They slightly are more resilient. So I think our view at present is that in a quarter or 2 quarters, I think we see a slight recovery in the luxury play in China. So we are expecting the market to grow at around 5% per annum average for the next 4-5 years. And at present, we think that is very reasonable and achievable. I think if Tata Motors is able to manage that, then I think the current downturn has been widely overplayed. If you look at the developed markets, Tata Motors has been doing well. The models have surpassed the previously phased out models. So which means that around the other parts of the globe, the company is doing fine. It's only about the China, and I think 1 or 2 quarters ahead of the Jaguar XE launch, the new segment, I think we should be watching closely. But at current 350, 360 prices, if you're looking around 7% JLR volume growth, if you're looking at the Indian operations, we seem to be doing better and expected to do better along with the recovery. I think this stock is really very good to buy for investors. According to us, it's a 4-star rating, which means it has adequate margin of safety. And I think investors should really have a serious look for good long-term returns on this stock.
Right, Piyush, thank you so much for joining us with the perspective on the metal names as well as Tata Motors. That was a view coming in on some of the names that can be impacted by what's going on in the Chinese market. Mayuresh Joshi is still with us. Mayuresh, you heard an analyst perspective on Tata Motors. Would you agree with the fact that at 350 levels, margin of safety is very, very high in a name like Tata Motor?
Well, yes, I would agree, Pankaj. And the basic premise, as Piyush was mentioning, that the markets have largely factored in the fall in Chinese volumes. And again, I think the basic parameters that we're looking at ex-China, I think the volumes have held up pretty well, specifically in terms of JLR numbers. The Jaguar XE, which is expected to launch over the next few months, I think you might see a good response happening on that front. The modular strategy that they are working on, I think that will have a huge impact. And again, I think there are Chinese plans, both in terms of engine sourcing and the Chery JV, that should start yielding results once the volume pickup starts happening a few quarters down the line. Even domestically, Pankaj, our view is that the MHCV segment has shown green shoots. So I think the numbers have shown resilience in the past few quarters. And again, I think as the capex cycle revives in India over the next few months, you will see further improvement happening with fall in crude prices, diesel rates, the fleet operability and the profitability increases multifold. And that again has a telling effect on how the volumes pan out, specifically on the MHC side. LCV is a little bit of a lag effect. So clearly, I think valuations very, very attractive at this point of time. And yes, I think it has taken into its stride at the current market price a lot of the bad news, specifically with relation to what the Chinese markets have meted out.
Right. Ashok Leyland numbers, did you manage to look at that? You think that that would also mean that Tata Motors in terms of recovery, could be faster, or, CV space could also surprise on the positive side? It can be very low in terms of an overall surprise. But do you think looking at the Ashok Leyland numbers, sooner or later, recovery in the Tata Motors MHCV would also happen?
So clearly, I think the story would be played out similarly for Ashok Leyland, and as I've been pointing out, I think the discounting per vehicle is expected to come down. The management is quite focused, in fact, in expanding their margins. I think the kind of margins that have come through, I think they did beat our estimates this time around, and it did hit our target price of 90 rupees that we had laid out for the stock. It's been a major outperformer for the better part of this year. So again, I think how the volume growth pans out for Ashok Leyland, how do they recover their market share specifically in the LCV segment, because I think the important aspect to be looked at is how production numbers will escalate in terms of output coming through their Pantnagar plant, which is free from taxes. So in that sense itself, I think that will have a telling effect in terms of how the top line grows for the company. And clearly, I think it will also be a key beneficiary on how defense orders flow through. So I think it's a play on both how the MHCV segment functions and how defense orders come through and what kind of execution we see. But again, as I said, we're very close to our fair valuation of 90 rupees where the stock is currently trading at, especially from an FY16 perspective.
Mayuresh, just a minute. IROS has declared numbers. I just wanted to read the numbers. It's a minor miss of about 5% 54 crores is the PAT number versus estimates of 57. It's down now 3% Sales numbers have come in, however, higher at about 472 crores versus an expectation of close to about 338 odd crores. So that's probably one name that you would want to wait. I think that because of the sales number being very, very high, maybe you get a sense that the PAT number may be influenced by the other income side, and maybe that's the reason why it's down. Shreyas Shipping, that's down 16%. I think again we have numbers coming in for Shreyas Shipping. It's down 16%, but it's a name which has done very, very well of late. Income at 135 crores versus 122 odd crores. No, not really sure if we can have a poll for Shreyas Shipping. Not many people track it, but it's been an outperformer. It's down 17%. Now we just have the sales numbers. We'll just put the other numbers in just a bit. 16% on the lower side. Mayuresh, what do you make of the mid-cap numbers? How they have been so far? It's been a mixed bag with a positive bias.
Oh yes, it's been a mixed bag, Pankaj, and clearly I think one really needs to differentiate which category of mid-caps you're talking about. So I think mid-cap IT probably has given a mixed bag. A lot of companies have disappointed. Mid-cap cement has disappointed. But again, I think our take is that it gives good opportunities to have stock-specific action within the space itself. But yes, largely I think mid-caps have been a mixed bag. So one really needs to be stock-specific when you're looking at the mid-cap sector as a whole.
Right. What do you make of Symphony numbers? I think the volumes were down almost close to about 15% plus. Sales had a big decline of 13% YOY. Do you think too much was priced into these names and now it will start to get correct? But the stock is, however, just down about, it's actually up about 1%.
So clearly, yes, it has been a little bit of a disappointing quarter for Symphony, Pankaj, and if you look at how the margins have panned out, I think it was way below what the street was expecting at 22.3%, if I recollect that what the margins were. So clearly, I think when you're talking about a market share in excess of 50% for the organized sector, the overall market size for air coolers, as we had gone through last time's report on Symphony, was close to 6 million odd units. The organized sector has 1/5 of that share, and Symphony controls 50% of that. So I think if you talk about discretionary spending going up, more and more people consuming, I think there is a huge amount of potential that players like Symphony, Bajaj Electrical can actually have. But clearly, I think valuations is one of the factors that will have headwinds for the company. And again, I think at these valuations, it looks a tad bit more expensive. So I think one really needs to look at a lot of other parameters in Symphony. Management commentary related to how growth is expected to pan out, how volumes are expected to shape up over the next few quarters, how their export markets are shaping up. So I think all these key parameters need to be understood from the management.
Any other name that you like from this space? Because most of the numbers don't really seem to be good. We had Page Industries also giving just 16% growth on a YOY basis. 21 was expected. Any other numbers that, any other, Havells was not that great. Any other, such sort of consumer durable story that you like? Bajaj Electrical, overall numbers were looking decent.
So clearly, I think out of this space, I think Bajaj is something that we would still prefer. Our take is that the EMP segment has done exceedingly well. The E&P segment, in fact, had EBIT margins of 5.8%, which exceeded our expectations. And if you look at a simple segment contribution, the E&P segment actually had EBIT losses of 87 odd crores for FY15. Our own take is with the turnaround that we witnessed in the E&P segment, FY17 numbers on the EBIT side should reflect profitability in excess of 90-95 crores, close to 96 odd crores. Couple that up with good show from the consumer durable segment, where we expect the margins to inch back to that 6.6-6.7% mark on the EBIT side. And the lighting luminaire segment, where we believe that the LED market poses huge potential for players like Bajaj Electrical. So clearly, I think expectations of top line growth in excess of 12% on a CAGR basis over the next 2 years is not ruled out. We are probably expecting profits to come in the range of 120 to 125 crores for FY17 from the losses that it incurred of 14 crores, and margins to probably come around 5.86% mark. So yes, I think on a valuation front as well, even at the current level, we believe Bajaj Electrical is reasonably priced.
Mayuresh, thank you so much for joining us this afternoon. Hope you have a great day going ahead. Crompton Greaves flashes at the bottom of your screen. 300 crore order is what they've got from Power Grid. Remember, Power Grid for the domestic side of the business is one of the biggest clients that they have. Overall order inflow in the previous quarter was decently good. So I think it will be taken in positively by the market. You can see a sharp reaction. It's up about 2.6 odd percent. Generally, for Crompton Greaves, you don't get inflows of news flow coming in, but this one seems to be on the positive side. 300 crores order from Power Grid, 2.7% higher. You're taking a quick break. Coming back in 2 minutes. Lots more lined up on the other side of the screen.